Hey guys, welcome to lesson 4. Today we're going to be talking about risk management, margin trading, all the different styles of trading, and long-term investing. The first thing I want to talk about is risk management. So the first way to manage risk is fundamental analysis, which is what I talked about in the last video, which is looking at the numbers, looking at the financials, looking at the earning reports, looking at how much money they make, looking at how profitable the company is, making sure it's a billion-dollar company, it's an established company, this company is doing great financially. The financial profile of the company is really great. So that's the first way, because if you make sure the company is good, the company will never go out of business. It's very unlikely for the company to go down if it's a billion-dollar company and doing so great year after year, quarter after quarter. Is just low risk. So you're preventing the risk of you investing in a bankrupt stock or a stock that's just going to decline over time. The second way to manage risk is technical analysis. So the type of technical analysis you need to do is looking at the graphs, making sure you're buying at a good price, you're buying at a discount, make sure you're not overpaying, make sure it's at a good time, basically timing. So the first thing was about the financials, now it's about timing, because you can buy a good company at the wrong time. So it's basically you already figured out the company's good. Now we need to figure out, is it at a good time? Is it at a good time? Is that at a good price? That way, if you buy at a discount, it's able to go up a lot because you're buying it low. So buy low, sell high. So the third way to manage risk is diversification, which means investing in more than one stock. Let's say I have $10,000, right? Let's say I put all that money on one stock and that stock goes down. I'm not able to make money because the stock is down. But let's say that I buy 4 stocks, I put $2,500 on 4 stocks, and then one of them goes down and other 3 go up. I'm still able to make money on 3 stocks instead of the other scenario where I'm down on one stock and I can't make any money. So it's basically reducing the risk because you're spreading your money out in different places. So one of the main things that you need to do in the stock market, because everything is going to go up and down, you're not always going to be up 100% of the time. But for the times that you are down, you want to make sure that you don't sell. So if the stock is down, do not sell. Keep it until it goes up, or at least break even, at least. Worst case scenario, break even. I would say that's the last way for you to manage risk, is just not selling at a loss. Do not sell. Don't lose money. Only sell if it's like it's going bankrupt or something, but other than that, you want to make sure that you're staying a little bit longer in the trade. That way you're not selling at a loss all the time and then watch it go up right after you sell it. So you want to make sure you're not doing that. So if the stock goes down, you don't sell, you didn't lose any money. What that's called is unrealized loss. It's a paper loss. So basically on paper it says that you're losing money, but it's unrealized because you haven't sold it. But once you sell it, it's a realized loss. It's real now. So you want to make sure that you keep your losses unrealized and keep them on paper, and then eventually it'll go up if it's a good company, like how I told you to look at it. After that, the stock go up, you can sell at a profit. So the next thing I want to talk about is margin. So margin means leverage. So let's say I have $10,000 and I start using margin. Margin will allow me to trade an extra $10,000. So instead of $10,000 that I put in, which is your money, which is the principal, you could trade $20,000 now. So it's basically your principal, your initial investment plus leverage, plus an extra $10,000. So now it's $20,000. So now you're able to trade with $20,000, which means that you can double your profit, and at the same time you could double your losses. But with the information that I'm going to show you, we're going to minimize the losses. So we're going to use that as a tool to increase our profits and make money quicker. That's the use of margin. Margin can make you a lot of money, can exponentially grow your account. Basically, it's like a short-term loan, because you're using the broker's money to make you some money, and then you pay them interest. You pay them interest every month on the amount that you borrow. If I'm able to use $10,000, let's say they charge me 1%, every month I would have to pay $100 interest to the broker. They'll take it straight out of your account, the $100. So $100 interest, but let's say that through the margin I was able to make $1,000, and before I was making $500. So yeah, you're paying $100, but you just doubled the amount of profit that you were making before that. So the margin is going to be a big deal if you're making money, and the money you're making is way more than the interest, and it would be way more than if you didn't use margin. So the margin can be used very effectively if you're a good trader, but at the same time, if you're a bad trader, you're going to keep paying interest. And on top of that, you're doubling your losses. So it's a double-edged sword. So let's talk about trading styles. Like the main trading style that I do is swing trading. So I'm basically buying huge dips, like huge price movements, like it goes like this, buy here, goes like this. The swing trading like is a swing. It's going up and down, it's swinging. So like swing trading is taking advantage of explosive price movement, of price movement that's moving very rapidly, very volatile, a lot of volatility. So swing trading just take advantage of the swings. The next trading style I want to talk about is day trading. Buying and selling in one day is a day trade, right? You do 4 day trades in 1 week in a regular brokerage account. That's not a day trading account. Your account will be banned for 90 days, or you have to pay a $25,000 deposit in your brokerage account to be converted to a day trading account. In a regular account, you're able to get up to 3 times margin. You're able to get 3 to 1 margin. So for every dollar you have, you're able to trade $3 worth of buying power. With a day trading account, you're able to do 4 to 1 leverage. So it's for every dollar you're able to trade $4 worth of buying power. So you're able to day trade unlimited times. In a day trading account, if you have the $25,000 deposit and you're able to get higher leverage, so that's a way for people that like to make quick money. That's a lane. So it's basically about picking lanes, finding what your style is in the stock market. What I want to talk about next is long-term trading. Long-term is keeping it for a year or longer. So if I keep a stock for 364 days, that's short-term, and then 365 days or more is long-term. So they have different taxations. So long-term, if you make under $36,000 a year, then you pay 0% income tax, or you pay 0% taxes on the capital gains if you keep it for more than a year and sell. You make $1 million, you're only paying 15% versus paying 39.6%, which is the standard marginal rate for a 6 or 7 figure earner. You're paying almost half of your money to taxes. Instead, with the stocks, you're paying 15% through long-term capital gains. So I think the long-term has tax advantages and has its place in the market for people that are legacy investors. So that means people investing for their retirement, for their kids' college, for the next generation, for basically people that have money that are going to sit there for decades and don't want to touch the money and want to let it grow. So like Warren Buffett is a long-term trader. Like he likes to keep his money in stocks for years. And that's how he's able to make 3-digit returns, is through keeping it for a long time. That's more long-term, but some people want to make quick money, so they're day traders. Some people don't want to trade as quick as a day trader. They want to trade moderately quick, so they'll just be a swing trader. Or some people that are not really worried about the money right now, they're just keeping it for the long term, for the long run, and they just do long-term investing. So it's every trading style is geared towards your preference. So you want to make sure that you understand your investing personality and your goals and what you want to do in the market. So there's lanes for everybody in the market. So today we just talked about risk management, margin trading, swing trading, day trading, and long-term investing. So for lesson 5, we're going to be talking about the SEC, laws and regulations, how people can manipulate the market, and how crashes happen, why they happen, and how to take advantage of them. So I'll see you guys in the next video. Stay tuned.